Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to this new episode of Through the Noise. I am your host, Ray Heung, Senior Investment Strategist with the CIO Office. With me today is Fook Hien Yap, also a Senior Investment Strategist within our CIO Office. Welcome, Fook Hien. Maybe let me start with a question regarding our market view. We are now expecting a consolidation in the equities for near term, while we are long-term bullish. Can you tell me what is the reason for a short-term consolidation in equities?
Ray, that's right. So equities and other risky assets, they have done well since we published our second half 2025 outlook just over a month ago. So global stocks, they have risen 6.4%, with Asia ex-Japan equities up 8.6%, outperforming US equities up 6.5%. So in the short term, many key markets, they look stretched based on our investor positioning signals as they are hovering around their key resistance. US trade policy remains the key event risk over this period. US policymakers, they have threatened to return to higher tariffs on major markets on the 1st of August. While more trade deals may be concluded around this date, the key focus is on the nature of agreements with the EU, South Korea, and India, especially after the deal with Japan appeared to raise the baseline tariff for allies to 15% from an estimated 10% earlier. And the next few months, they also bring us into a seasonally volatile period for global equities, particularly in September.
I see. So in the longer term, why are we bullish on equities?
Yeah, longer term, we are bullish. We remain overweight on global equities. This is underpinned by strong earnings, fiscal stimulus in key markets, and expectations of a soft landing in the US economy. On a fundamental 6 to 12 month outlook, our quantitative models, they have also turned quite bullish. This improvement has been driven by, firstly, better fundamentals amid earnings beating expectations, and secondly, still constructive valuations in the ex-US markets. And thirdly, a strong breadth is seen in the equity market participation, with more than 85% of equity markets being above their 200-day moving averages. So this means that while we expect some volatility over the coming months, we would prepare to take advantage of such volatility to add to our preferred regions. So Asia ex-Japan continues to be our most preferred region, where the US dollar rebounds are likely to create improved entry points. However, we continue to see core allocations to the US, Euro area, and Japan as key components of our view to take advantage of volatility. Within Asia, we remain bullish across our major markets, including China, Korea, and India, though we maintain a near-term relative preference for the China and Korea equity markets.
I see. You also mentioned the US dollar rebounding just now. What is your view on the dollar?
Yeah, we see a temporary rebound now in the US dollar, similar to the temporary consolidation that we expect for global equities. As we laid out in our second half outlook for 2025, we expect the potential for narrower rate differentials and uncertain US trade policy to result in a weak US dollar over the next 6 to 12 months. But over the next 1 to 3 months, though, we do see room for a temporary US dollar rebound. Positioning and investor survey data, they show that the bearish US dollar view is increasingly one-sided, an outcome which often results in a counter-trend move. But this does not change our fundamental weak US dollar view, but does mean there's an opportunity to add to assets that benefit from a weak US dollar. And this opportunity is likely to arise in the next 1 to 3 months, which means adding to a diversified equity allocation with a tilt towards Asia ex-Japan equities, and also adding to your emerging market local bonds.
Thank you, Fook Hien. So you just mentioned about bonds. Maybe the question is, aside from the EM local bonds, what are the recommendations for bonds right now?
Yeah, global bonds are a core allocation to us. We retain our view that the 10-year US government bond yield it will return to a 4 to 4.25% range in the coming 6 to 12 months as the US economy experiences a soft landing. A temporary rise in the yield towards 4.5 to 4.6% remains possible amid market worries about trade, inflation, and the fiscal position in the US. However, we maintain our view that such spikes are opportunities to lock in the yields. The recent volatility reinforces our preference for the 5 to 7-year bond maturity bucket. And the recent episodes of upward pressure on US, European, and Japanese bond yields was a good reminder that whilst it is tempting to own very long maturity bonds for the yields or exposure to potential price gains, volatility in these bonds they can be high. So we would use US dollar rebounds to add to emerging market local currency bonds, which is the area where we are overweight within global bonds. We also have a new opportunistic idea in bonds, which is on the short duration US high yield bonds.
Yeah, on the short duration US high yield bond, can you tell us a little bit more about this idea?
Yeah, we view this idea as an attractive way to add to risky assets while taking slightly less risk than longer maturity high yield bonds. So the short duration US high yield bonds, they have an attractive absolute yield, currently 7.2%, and it has a low expected default rate of below 2%, which we see as the key performance drivers. So the short duration bonds have lower price volatility and lower drawdowns than both the US high yield and US investment grade corporate bonds, and hence they offer a better risk adjusted returns.
I see, I see. Lastly, maybe can you tell us a little bit about our view on gold?
Sure, we maintain our core allocation to gold. We expect the gold price to remain range bound around $3,400 to an ounce in the near term. For the uptrend in gold to continue, US economic conditions would need to deteriorate further, and US tariff risk would need to re-intensify. So the upcoming 1st of August US tariff deadline, it could act as a near-term catalyst for gold to retest its all-time high near 3,500. However, unless market confidence in the Trump put erodes, any upside is likely to be contained. And also a re-escalation in US-China trade relations ahead of the 12th of August tariff deadline for China that could revive gold demand through Chinese gold ETFs or exchange-traded funds. Demand for these ETFs they has recently softened. In the meantime, investor interest has broadened to other precious metals. So we maintain our core allocation to gold. While gold is likely to consolidate for now, we expect continued central bank demand to drive the next leg higher. We also view it as an attractive inflation and a weak US dollar hedge.
I see. Thank you, Fook Hien. And that's all the time we have for today. Thank you all for listening, and please also have a read on our just published Global Markets Outlook for more details. And until next time, we see you in the next episode of Through the Noise. Bye now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.